Welcome back to the deep dive. Our job is to take the complex, high-stakes information that lands on your desk and distill it into crystal clear, actionable knowledge.
Today, we are undertaking a deep dive into the fascinating world of XRP. Our source material, it spans market reports, legal analyses, fintech journals, all dated around December 2025, and they tell a singular story.
And that story is the shift of a major digital asset from speculation to real infrastructure.
Exactly. A shift defined by the resolution of a really brutal 5-year regulatory battle, the SEC versus Ripple case.
Which finally provided this unprecedented legal certainty in the U.S. market, and that has fundamentally changed how Wall Street sees this asset.
So our mission today is to analyze the quantifiable impact of that victory. We're talking about the flood of institutional capital pouring into XRP through new ETFs, the utility thesis around global payments, and, the big question.
The $12.50 question.
Whether these factors actually justify those highly optimistic price targets some analysts are throwing around.
It's a tension between a floor and a ceiling, and I think it all begins with understanding the basics. Okay, let's unpack this. Before we can even look at nearly $1 billion of institutional money flowing in, we have to grasp the core architectural difference between the two titans here. Bitcoin, the incumbent, and XRP, the payments challenger.
They're built for two completely different economic purposes. Completely different. Bitcoin, or BTC, is purely a store of value.
Right.
Its architecture is intentionally slow, it's energy intensive in proof of work. The whole goal is maximum decentralization and security.
So it's like digital gold. Slow, precious, hard to move around.
That is the perfect analogy. It's decentralized, it's inherently scarce with that hard supply cap of 21 million BTC.
Yeah.
And as a result, transactions can take, anywhere from 10 minutes to several hours.
And the fees can get crazy.
Oh, they've been astronomical. We saw fees reach $128 during major congestion.
Right.
So it basically sacrifices speed for absolute trustlessness.
Okay, now contrast that with the challenger. If Bitcoin is digital gold, what is XRP?
XRP is the ultimate digital plumbing. It was designed from the ground up for massive throughput, specializing in cross-border transactions.
So speed.
Speed and efficiency. It uses an energy-efficient consensus protocol. We're talking about concurrent settlement in 3 to 5 seconds. The transactions they're incredibly cheap. A tiny fraction of an XRP is burned per transaction. It's all about utility and scale.
But the critics always say that speed and low cost, they come at a price, don't they? Centralization, that's the core tension.
It is, and it's a valid point of critique. Unlike Bitcoin's completely decentralized mining system, XRP relies on a much smaller set of trusted validators to reach consensus.
Which makes it more efficient for banks.
Far more efficient for institutional use, yes. But it means it doesn't offer that same degree of, let's say, total decentralization that Bitcoin maximalists demand. It's optimized for the financial system it wants to serve, not necessarily for a total rebellion against it.
And here's where it gets really, really interesting. That utility was for years just overshadowed by the massive threat of the SEC lawsuit. So let's shift to that watershed moment. Walk us through the legal outcome of SEC versus Ripple.
So the charge began back in late 2020. The SEC sued Ripple, claiming they raised over $1.3 billion through unregistered security sales of XRP. The critical turning point, though, was that landmark ruling in July 2023.
The bifurcated ruling.
Exactly. That ruling is what cleared the air for really the entire crypto sector.
And this bifurcation that public sales are fine, but institutional sales are securities. That's the key, right?
Yeah.
What did the court actually decide about XRP itself?
It made a huge, unprecedented distinction. The court ruled that XRP is not a security when sold to the public on digital exchanges.
So-called programmatic sales.
Right, programmatic sales. However, and this is the key, the exact same asset is a security when it's sold directly to institutional investors via contracts. The classification hinged entirely on how it was sold, not the nature of the coin.
Which means the SEC, in a very roundabout way, effectively validated the retail trading of XRP.
Absolutely. The significance was immense. It basically provides a legal playbook. So fast forward to August 2025, and the case effectively concluded. There was a joint motion to dismiss appeals, and Ripple agreed to pay a penalty.
$125 million civil penalty. And while that sounds like a lot of money, it's just a fraction of the $2 billion the SEC originally wanted.
A tiny fraction. Analysts pretty much universally called it a comprehensive strategic victory for Ripple. It turned them from a regulatory pariah into a legally compliant pioneer.
And that's the core takeaway. Legal clarity in the U.S.
Essential legal clarity, yes. It validates XRP's status as a non-security for you, for the general public. And for institutions, the rules is now clear. Direct sales have to follow security registration rules.
We should also probably touch on the broader regulatory wins in the U.S.
We should. Some of our sources suggest that a potential shift in the U.S. administration could lead to a more permissive regulatory framework, moving away from just enforcement actions and more toward creating clear rules.
Which just further supports XRP's standing.
It minimizes the chances of any future heavy-handed intervention.
So legal certainty opens the gates for big money. Let's pivot to that institutional influx because the numbers here are, frankly, staggering. Describe this ETF demand surge.
The institutional money did not wait. Since mid-November 2025, the U.S.-listed spot XRP ETS funds like XRPC, XRPR, XRPZ have seen this really aggressive accumulation.
How much are we talking?
Nearly $900 million. Specifically, $897.35 million in net inflows. And this is happening at a phenomenal speed, putting them on track to hit $1 billion, making them the fastest growing altcoin ETF since Ethereum.
Hey, hold on, 900 million in inflows for XRP while other major assets are seeing massive outflows. That sounds less like rotation, more like a systemic vote of confidence.
It is. That's the clearest evidence of the structural shift. Market data shows in that exact same period, Bitcoin ETFs lost $2.6 billion. Ethereum ETFs shed $691 million.
So it's not a bull market lifting all boats.
Not at all. This suggests large institutional capital is deliberately rotating away from saturated large caps and into regulated mid caps like XRP, precisely because that legal risk is now off the table.
And the validation is happening beyond just ETF inflows, right?
Yeah.
Wall Street is actually giving access to its clients.
Exactly. Major brokerages, firms like Vanguard have started allowing XRP ETF trading. This immediately grants regulated access to tens of millions of US clients. We're talking over 50 million people.
Which just transforms it from a niche crypto asset into a broadly accessible investment.
And beyond that, there was a huge corporate endorsement.
The funding round.
A massive one. Ripple secured a $500 million capital funding round from prominent Wall Street firms. Affiliates of Citadel Securities and Fortress Investment Group were in on it.
When you have titans like that putting $500 million into the company, that's a powerful statement.
It's a huge validation of its enterprise potential, regardless of what you think of the public token.
And these ETF inflows, they aren't just paper trades. They physically pull tokens out of the market, which has to affect supply.
It does. The ETF model requires the actual purchase and sequestration, the locking up of the underlying asset. To date, nearly 478 million XRP tokens have already been moved into ETF custody.
Which tightens the supply.
It reinforces a tightening supply dynamic. It's a crucial structural floor for the price. The institutional money is acting like an absorption layer, just soaking up available supply.
Which brings us back to the initial supply. XRP was created with 100 billion tokens, but not all of that is actually on the market.
That's key. Of those 100 billion, a very large portion, nearly 40 billion, or almost 40% of the total supply, is held by Ripple in a cryptographic custody. It's called an escrow.
And they release some of it every month.
A certain amount, yes. And while it's designed to manage supply and fund their operations, it's also seen by critics as a concentration risk. We can revisit that later. So now that we've got the regulatory green light and the institutional buy-in, we have to talk about XRP's core utility. This is the whole fintech coin thesis.
Its role as a bridge currency.
Exactly. And its integration into traditional finance and government systems.
ODL is the engine here. You mentioned Nostro accounts earlier. Can you just explain simply why ODL is such a game changer for a bank's balance sheet?
This is the financial pain point XRP solves. A Nostro account, Nostro is Latin for ours, is just a foreign currency account a bank holds with another bank overseas. To move money, banks have to pre-fund billions of dollars in these accounts all over the world.
So it's just dead money sitting on the balance sheet.
Precisely. It's just sitting idle, not generating interest, tying up critical capital. Ripple's on-demand liquidity, or ODL, it eliminates the need for that. Instead of parking capital, a bank uses the public XRP token as a bridge asset for just a few seconds.
So local currency in one end.
Converted to XRP, it zips across the ledger and is instantly converted to the target currency on the other side. This frees up billions of dollars. Ripple has over 300 partnerships globally using the system.
And that legal clarity in the US is now being leveraged for global expansion. I see a lot about Europe.
Absolutely. Ripple is aggressively seeking regulatory clearance under the European MiCA framework. MiCA is the Markets in Crypto Assets framework, and it's this comprehensive structure for the entire EU.
And getting that clearance would be huge for scaling.
It would, and the XRP ledger has already shown it can handle regulated European finance. It successfully integrated EURIP, which is a MiCA-compliant, euro-backed stablecoin. It proved the ledger can handle these highly regulated assets.
And we also see Ripple involved at the highest level. Central bank digital currencies, CBDCs. How does XRP play into that?
That's a massive part of their strategy. Ripple offers a dedicated private ledger built on their technology, specifically for central banks to issue CBDCs. And crucially, the public XRP token can act as an interoperability bridge between different CBDCs.
So like between a digital euro and a digital yen.
Exactly, as they demonstrated in things like Project Dunbar.
Okay, but this raises the critical nuance we have to dissect. If the central bank of, say, Japan uses Ripple's private ledger for their CBDC, does that transaction or activity ever actually benefit the public XRP token that I can buy?
This is the key tension. It's the core structural risk facing the token. Central banks, they overwhelmingly prefer their own centralized private ledgers. It gives them total control.
Control over monetary policy, transaction visibility.
Everything. So if Ripple is highly successful in selling this private ledger software to central banks, it could potentially cannibalize or at least limit the widespread adoption of the public XRP token's ODL utility.
So the company's success might not directly translate to the coin's value if those private CBDC ledgers handle all the cross-border volume.
Exactly. The value of the public coin is tied to ODL adoption. The value of the Ripple Corporation is tied to selling compliant centralized software to governments and banks. It's a crucial distinction for any learner looking at this.
Let's transition now to the financial outlook. We have this perfect storm of clarity, demand, and utility, but what are the different price paths and major risks that the analysts are pointing to?
Okay, so currently in December 2025, XRP is trading around $2.02. It's a consolidation phase. Technically, it sits just below a major resistance cluster between, say, $2.13 and $2.47.
And it's been down recently.
It has. The 33% price decline over the last 90 days, that exhausted the immediate SEC rally from August. But that institutional ETF demand is providing a crucial structural floor right around the $1.97 macro support level.
So stability for now, but the sources are showing these massive contradictory price targets. What are the two camps projecting?
They break down into the technical, cyclical camp and the utility-driven camp. The cyclical analysts, they look at past patterns, specifically the 21-month EMA cycle that mirrored that huge 2017 breakout. Based on that, they project a volatile surge to a new all-time high.
Past $3.84?
Potentially, yes. Peaking maybe in the first quarter of 2026.
But that prediction comes with a pretty severe warning.
It does. They explicitly warn that this cyclical surge is likely to end in a, I'm quoting here, a sharp rug pull style crash once that peak is hit. On the other end, you have the utility forecasts, which are far more optimistic.
Right.
You see conservative models predicting maybe $2.58 by 2030, but then the aggressive institutional predictions, like those from Standard Chartered, they're forecasting $12.50 by 2028.
That $12.50 target is predicated on one massive assumption, though.
It requires XRP to capture a significant, meaningful chunk of the estimated $250 trillion global cross-border payments market. That's the ceiling. Without that massive adoption, that figure is just a theoretical possibility.
Finally, let's just revisit the structural risks that have nothing to do with market volatility. We mentioned the escrow.
That concentration risk is primary. Ripple owns nearly 40% of the total supply in that escrow. Right. And while this lets them fund operations and, governments like dealing with a central entity, it's still seen by some as a risk. That supply could theoretically flood the market.
And there's also just a hard mathematical hurdle for the average retail investor chasing huge returns.
Yes, the market cap reality. For an asset like XRP to turn a small investment into $1 million, its total market cap would have to climb into the multi-trillions. We're talking $6.2 trillion.
Which, for perspective, is higher than the entire U.S. tech sector's market cap right now.
Exactly. So analysts are clear. While utility drives long-term growth, the massive, explosive gains of early crypto are just mathematically improbable at this point. So the core takeaway for you as a learner is that XRP has successfully navigated this shift. It's moving from being valued purely on legal risk and speculation to being valued on verifiable utility and, most critically, legal compliance.
And that institutional money, the nearly $900 million flooding into ETFs, that provides a definite structural floor. It validates the asset as legitimate infrastructure. But the actual leap to that highly ambitious $12.50 ceiling.
It depends entirely on Ripple's ability to force adoption in that $250 trillion market using the public token.
So here is a provocative thought for you to mull over. The resolution of the SEC case proves XRP is legally compliant infrastructure in the U.S. public markets. But if central banks ultimately adopt Ripple's private ledger for their CBDCs instead of the public XRP token for ODL, how much value does global compliance truly add to the public coin, and where does that utility value ultimately settle? We'll leave you to chew on that one.